So let's start with that Aussie yen. We talk about just trading crosses in general and things. If Asia's down, you'll then look for pre-London continuation to the downside. Right? Look at what happened yesterday on the pound. Right, Asia up. Where is the next level of resistance? If it is down, you're saying to yourself, where is support and where is resistance? In other words, can it continue? You're going to go look at your charts. Well, has it got room to continue, yes or no? And how are you going to work that out? By looking at your longer-term charts, by looking at your pivot points. Next thing you're going to say, if it is heading down and it has got enough room, it still has room to the next level of support, well, then you need to be saying, right, if it's down, where is resistance to short from? And if it's up, you're saying, where is support to short from? Okay, Asia took us down, right, tick that. Next thing, where is our next support level? It's over here. Why? Because of that trend line and whatever else. You know, from where Asia took us down, we have another 50, 60 pips to the support. Fine. Next level of support, plenty of room there. Good. Where is resistance to short from? Grab the fib, measure it. Notice that this is a 382. Not only is it the 382, but the confluence area here was his previous swing highs, hesitation zone, buying and selling all day today at that one particular level. Fantastic. Let's put an alarm there. Next thing you're doing, check that box. Then after your alarm is set, you wait. Right, waiting done. Okay, price hits alarm. Execute. Done. Job done. Pre-London continuation trade handled. The same exact trade presented itself yesterday, just on the upside. Right, Asia up. Has it got enough room to resistance? Yes, 160.40. Right, where is support? This is a 50% of this rise here, and it's these previous wick highs and lows through here. Great. Put alarm. Then wait for alarm to be found. Alarm's hit. Execute. Right? Take trade up to target. Take profit. Well, I typically don't put orders where my alarms are, just because a lot of these things are very time sensitive. I also watch for the prevailing correlation at the time. Can I take a 15-minute change of trend off a 15-minute move fib or swing fib? That ain't going to happen, no. Enough of that stuff. I just wanted to reiterate it because I think conservatively there's a 40, 50 pip trade on a pair or two for you 3 or 4 times a week, trading nothing but the Asia continuation. You know, I could see you making 120 pips a week based on that one little bit of information. That's 480 pips a month. That's 5,000 pips a year. It's not bad. Now, Aussie yen. You've got to remember something about trading a cross, is that the actual cross is a figment of your imagination. You're actually seeing things. Here's what I mean. Okay, everything in the Forex market is a derivative of the USD, is it not? Can somebody give me the price of the USD yen right now? 77.36 multiplied by the price of the Aussie dollar right now, 1.0594 equals. I'll take Aussie yen price for 200, please, Alex. The Aussie yen doesn't actually exist. Let's do another one, you and I. Take the price of the pound dollar right now. Pound dollar is 159.27 multiplied by the price of the yen, 77.35. Right, what is the price of your pound yen right now? Right around 123.20, give or take, for spread and some things, and just volatility. Why am I bringing this up? Like, why is this important? It all depends on the dollar. It's all dollar dependent, ultimately. Well, it's a cool trick, and I can probably show my friends at parties, but it really doesn't serve me anything. Well, here's the thing, yes, is that they're actually not really on their own. If you're going to trade the Aussie yen, you've got to have a fair idea as to what the Aussie dollar is going to do and the USD yen itself. Now, here's the part that boggles my brain. If crosses are simply crosses and just derivatives of USD pairs, how do they respect technical levels? How do they trade as their own entities? And the answer to that is I have no idea whatsoever, but I don't care. The reason why I'm bringing this up is if you take a look at the yens right now in general, I trade the crosses all the time. But I like to trade the crosses when you've got positive correlation between the base currency and the quote currency. Good relative strength. That's when the crosses become good. And frankly, if the dollar is moving, I've got no interest in trading the crosses. None whatsoever. It's just more complication and more moving parts to my trading I don't need. Remember the goal. The goal is to make 50, 60 pips, easy pips a day. Easy money, right? 50, 60 easy pips a day. So whatever's relatively strong versus whatever is relatively weak, just do that. Here's our problem with the yens right now. These are 4-hour yen charts. Here's the USD yen. Okay, this looks like a magnificent move, but really it's in a 100 pip range. The euro yen is down on the weak euro. This Kiwi yen has gone all the way down, come all the way up, and is kind of just sort of hanging out in the middle. This Aussie yen has gone nicely up on the 4 hour, sort of jogging up, so it looks like it's stepping up. You take a look at the pound yen, it's in a steady down move here, and basically looking for this to sell it. You've got the Aussie yen saying up, you've got the US yen saying sideways, you've got the euro yen saying sideways to down, and you've got the Kiwi yen saying sideways. So really, is the yen actually a major factor in the yen crosses right now? Not really. Not really. It's not. I prefer not to, because a lot of times the correlation is going to change, the relative strength could change, any number of new pieces of information could enter the market. An alarm for me is just a level to which I'm thinking about trading at. You could use limit orders if you're so inclined, if you trust your analysis to that extent. Sure. Here's another little piece of the pie. Okay, here's an Aussie dollar 2 hour. Here's the USD yen overlapping the Aussie dollar. Now, why are those two important? Because they're the two currencies that make up the Aussie yen. And I'm cutting to the chase in a minute. Okay, the reason why I'm bringing this up is for a cross to move in a fluid manner, what do we need to see happen? We need to see positive correlation between the base currency and the quote currency. Yes, at least the yen has to be heading sideways, or the base currency has to be heading sideways. Then you're going to get a nice move out the cross. So now look at this. We're getting fleeting moments of positive correlation. Okay, look here, negative correlation, negative, negative, negative. Okay, positive correlation. Right, back to negative. Back to negative correlation. Negative correlation. Negative, negative. Oh, okay, here we're momentarily positive. Great, we pretty had a nice trading opportunity. Right, oh no, now we're going back to negative. Okay, and here, great, positive correlation, positive correlation, positive correlation, positive correlation. Here, almost positive correlation again. And now we've gone back to sort of mixed. So my question is the Aussie yen the best pair we're probably concentrating on right now? Probably not, guys. Probably not. If you're looking at an Aussie yen right now, you're really probably only looking for Aussie exposure. What would we say our prevailing trend is right now on this daily chart? Strictly speaking, we're making higher lows and higher highs. But ultimately what it looks like to me a little bit is a little bit of sort of a continuation trap here. So it looks to me like we're wanting to do a little bit of something like this, and then it'll probably try and head up again. This almost looks like a little flag here, doesn't it? To the downside. But it's messy. I don't think we have a fantastic directional trade going on. And we saw that reflected in our little bit of correlation analysis that we just did on the previous screen. All right, so the daily chart not really telling us a lot. If anything, we can probably take a horizontal line here and say, look, 83 has been monumentally important. Well, we're going to try to figure it out. I mean, it all just depends what you're looking for in terms of a trade. If you're looking for a spot trade, I'm sure we can find a spot trade. If you're looking for a swing trade, I'm sure we can find the swing trade. I think if you're looking for a trade with meaningful pretensions, you're going to look for a little short in here that you're trying to take down to 80 cents, just based on the daily resistance, all right? And I would work out how to execute on that kind of trade at the moment. What I'm really trying to do here is I'm really actually trying to talk you out of trading the Aussie yen at the moment. But because you asked for it, we're going to apply ourselves here a little bit. The Aussie dollar is very similar. I'll give you the 2-minute rundown on that in a sec. What I'm actually when I look at this 4 hour, it makes me think, or something like this. You know, in other words, higher low gives us a higher high, probably up to around 83. Failure there, jogs down to 80 cents, resurrects the trend and continues up. This looks long for about 100 pips, which disagrees with the Aussie dollar a little bit for me, but I could see the yen making up the difference. Right, so what I would be looking for is a little something like this. Given the fact that we're at the top, so I'd expect a little dead cat bounce on this Aussie yen. So I'd look for a trade that looks like this. Lower high down to around 81.50, jog it up to around 80 to 80, 83, and then look at the short side. I really think it's in a pickle now, guys. I really think the Aussie dollar is needing a breakout because this here is a 618 to this drop in the weekly central pivot. Excellent Asia short, but as no-brainer as it gets. Yeah, I'll show you in the 4-hour. Asia opens up today on the Aussie dollar at a 618 to the drop and a weekly central pivot overlap. Do you really think they're going to buy it there? This is freaking perfect short. So down she comes. Now, you grab the fib of the rise, and you're like, well, hang on a minute, it's coming off at 50%. So I'm coming off at 618, and I'm making a higher low of the rise after making a double bottom. So who do I believe? Are we doing this, or are we doing this? Blue track or black track? Have absolutely no idea. And I sold it again at 106, and I've just got popped on the reload. So now what we need to do is we need to get a little more zoomed in and let price tell us which way it wants to go. So how are we going to do that? Grab an hourly, and we set ourselves right. Grab the little fib of this drop, and we say, okay, cool. As long as we're below our red zone here, we're going to remain bearish. So maybe if we get a little lower high or change a trend around 106, 106.15 or, a lower high, you really couldn't wait for a change of trend. But a little lower high, and possibly a short, and if we break that, you're probably heading up. And that's going to tell you that these guys have won out. So at the moment, I really think that you don't do anything on the Aussie dollar in this space. I think you just leave it. You leave it between 106.10 and 105.75, and you let price work it out from there. I like to manage my trades fairly simply. My biggest error as a trader was that I was right on a lot of stuff analytically. However, I would find a way to botch the trade. In other words, I would always find a way to lose money even if I was right. In other words, I would never give it the right stop. My stop would either be too tight or rather, when it wasn't too tight, then I would, inevitably I'd pick the wrong side of it. So in other words, I would have a stop too tight initially, and then it would come and knock me out and go in my direction. Or I would give it too much room, and then it would hand me a catastrophic sort of stop, and I would have to go and sniffle in the corner. There's two types of people out there. There's analysts and then there's traders. Okay, analysts make 80 grand a year. Traders make 80 million a year. I truly believe that the difference between an analyst and a trader is somebody who can make analysis into money. So what does that take? Sound psychology, patience, discipline, and a little bit of luck. You need to have sound money management and a set of rules for how you manage trades, because an emotional approach to management often is worse than an emotional reaction to entry. What I mean by that is this. I manage my trades in a couple of ways. Because I'm a fib guy, I'll have a catastrophic stop and then a manual exit stop. In other words, a discretionary exit point. I would not advise that if you are newer to trading or a novice. But basically for me, I will exit for loss if I have a 15-minute change of trend against me and a break of the support or resistance I'm trying to short off of. Asia is down, blah, 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 blah. Line up the fib. Okay, here we are. All right, and this is why I like to trade with the trend almost 100% of the time, because you can define the risk. Our red zone here on this trade is this area. I'll never trade a breakout, always trade or support or resistance, always. And I never speculate. Meaning that I never try to guess. If I don't have a good idea as to the direction, I simply won't trade. It roots back to that trying to make 50, 60 pips a day thing. It's like, well, if I'm going to watch 2,000 pips go in front of me, why wouldn't I just wait for like the 50 obvious ones and just pick on that repetitively? Trade like this, right? Red zone. Stop loss up here. So that's my catastrophic stop. You can see the wick lows here and some other stuff. If price printed or closed the candle above here, that would get me out of the trade. Why? Because it's breaking resistance. However, As long as we're below that, I stay in the trade. So as long as we're below that, I don't care what this thing does. It can turn as many tricks as it wants, providing we're below that red zone, I'm good. This sort of slow-to-react approach costs me some slightly larger losses. Sometimes, instead of taking a minus 15, like, say, Chris Stevens will, I'll take a minus 25. However, it's also keeping me in some better trades. The first 30 pips of a spot trade is the sort of very delicate, embryonic sort of state of a trade, isn't it? If you cannot manage the first 30 pips, you're done, bro. Because, George, a lot of times you're going to come and you're going to wick this area, you're going to close below it, you're going to muck around here, and the trade's still going to work out. And providing you haven't closed above there, you're good. So I cannot tell you countless times it's gone up there, freaked everybody out, and those reacting just jump ship, and I'm like, oh, it's good. We haven't closed above there yet. Oh, awesome. Let's go. So that's why, because I don't want my stop to be anywhere near where anybody else can grab it. Big benefit to trading with the trend in a fib is to define the stop. So if I said to you on this, go ahead and short that. Go ahead and short this. So you're like, cool, I'm going to short that. Great. Now I say to you, where's your stop loss? This is the thing about trying to pick tops and bottoms. And you say, oh, I don't know. Well, how do you know when you're wrong? At what point do you know when you're wrong? So picking tops and bottoms to me is simply doesn't make sense to me risk-wise. Your job in Forex is to regulate your risk. I might look at a shorter-term chart sometimes for execution, but I'll put it away for management. Now, contrast that to something like this. Okay, price comes down and you grab this short. Right, now you can say, oh, okay, I think that might be the top. Let me short that. Right, let me put my stop loss. Guess what? You've got defined risk. Do you see how this is very different to trying to shorting a top? I encourage you to be very careful about speculating on tops and bottoms. This isn't only for the practice of maintaining good risk reward, but this is also psychological. Because there's something nice about going into a trade. Nice isn't the right word, but there's something comforting about going into a trade knowing exactly how much you could win or lose, or particularly lose. You know, so if you enter this trade and you're like, wow, I got to risk 43 pips in this, it's not worth the quality of that trade's not worth it to me. Okay? You know, and you can use a bit of discretion through that. Yeah, I mean, this is a trendline bounce here, guys. You're at London Open, at support, you're going to change the trend. We're going to wait for a pullback, a higher low, and we're going to long bomb it. Try and take it up to the 85. I like to break my trades up into thirds. Always have a target in mind. All right, so let's say that you are trying to capture a 100 pip trade. I like to think about them in terms of thirds. 1, 2, like that. Okay, so let's say that you are shorting up here, target down here. And these are 30% of the trade. That no matter what you do with money management and exit, you are ultimately always going to be wrong in some capacity. Just accept that psychologically, that you're always going to be wrong. It's just being less wrong is about the best you can hope for. All right? Everybody kind of agree with that? Because inevitably, if you take profit, it continues to run. If you don't take profit, it comes back and knocks you out. In hindsight, you can always be like, oh, I should have done this differently. It's always a moving target. I'll never risk more than 0.5% on a trade. I prefer to go in small and add to the winner as opposed to leverage up to begin with. What I like to do is have at least 2-to-1 risk reward. So when I initially enter the trade, the risk is going to look something like this. Okay, risk reward. You're not going to be able to keep the risk and the reward that proportional throughout the trade. It's going to have a bit of a concertina effect. You're going to have initially minimal risk for lots of reward, and then it's going to sort of balloon out to be about the same risk reward, and then you're going to have to try and bring it back into context. All right, so what I mean is this. Let's say now you get in this trade, and off she goes. Okay, if I'm looking for 30 and it's gone 30% of the way in the trade, so I'm looking for 100 and I'm plus 30, I can lock in break even here. Break even. So the first third of the trade, I go break even. Next thing, cruises into the second third. Now I might be up, say, 40 pips, 45 pips. At this point, I can go plus 10. No more. I'm now going to move my stop to about here. My risk reward looks like this. Remember, it's unrealized profit now. So if this is where price is, my new risk reward is going to look something like this. Make sense? And you've basically locked in 10 pips. And this happens in the second 30% of the trade. Okay, so here's the deal, guys. Now price continues. Well, hang on a minute. Now you're up 60 pips out of your 100 pip trade, or 65 pips. Do you want your risk reward looking like this now? Risk reward? Is that prudent? Is that prudent to have it looking like that? No. No. It's one thing to have it sort of half-half. It's one thing to risk what you're going to get in the reward. But guys, it blows my mind when I see people, well, I was looking for 70 pips, and I was up 58, and now it stopped me out break even. What are you thinking? Well, I was looking for 45, and I was 37 in profit, and it knocked me out for nothing. Like, dude, really? Come on, bro. What you want to do here is you want to get this risk reward back to where it's tolerable. So when you get into the second or this last 30% of the trade, you now bring your risk reward almost from where you began the trade. So now you take your stop from this plus 10 and you move it aggressively to here. Okay, and the reason why you leave the stop way back there initially is because you need to allow price to come back and fib back to the 618 before continuing. But now what you're going to do is when you sort of plus 70 out of your 100 is you now want your risk reward to start looking like this again. Okay? Now your risk reward's back to where it needs to be. You know what? And if it comes back and knocks you out for 60 and then goes to the target, cry me a pancreas. If it sort of goes to the target some more and now you aggressively start to move your stop. Now, as soon as it gets closer and closer and closer, you start to risk less and less and less and less as it gets to the target. And then when it gets to the target, you never get out. You just move your stop there and you're effectively taking profit. And if it falls through the floor, you're good. Whatever the risk reward is. So if I'm trying to get 20 try and trade, I would trail 10. If I'm trying to get 30, I'd probably trail about 12. And like I said to you before, guys, you know, sometimes this will come back and knock you out and then go to the target. But you know what? You cannot fake a 40 pip trade. You cannot fake a 50 pip trade. If you're up 50 pips and you're looking for, say, 65, get 40 pips out of that thing. Now, if you are looking for 255 and you are up 83, yeah, okay, you can't do anything. You're just sitting. If you are looking for a swing trade, treat it as a swing trade. If you are looking for a spot trade, treat it as a spot trade. Don't try and say, oh, I'm looking for a swing trade. I'm looking for 200 pips, and you're up 60 and you lock in 30. Well, at that point, you haven't taken profit on the spot trade, and you've now stifled the swing trade. So now you're going to get knocked out for 30, and the trade's going to work out, and you might as well have got knocked out for 60. And that is my money management, guys. Guys, the challenge is this. I am up 32 pips in a trade where I'm expecting 40. Now what? And it starts to look weird. I'm up 32 and I'm looking for 40 and it's looking weird. That's the challenge. I mean, you really can't do anything. You're either going to take full profit or nothing at all. You're either going to take full profit or just leave it at break even. The other cardinal error is, okay, it's hit my target. You let it retrace 20 pips and then you get out. Think about that. Oh, look, it's hit my target. Great, now you sit. You're like, oh no, it's retracing. No, I just gave back 32 pips. Let me get out. I'll just get out with 18. Oh, make a decision, bro. Okay, at that point, you kind of just got to stick with it. You've screwed the pooch already. Do I scale in? Yeah, if it's a fib trade and I think to myself, right, it could get short at point A, and if it goes higher to point B, that's sort of the next level. Yeah, sometimes I'll put on a trade at A, and if it goes up to B, I'll add to it. But I'll make sure that wherever my stop loss is, the collective trade there does never exceed about 0.5% of my trade account. But that's really the only application I'll use for scaling into some stuff. Yes. I'll never reload if the reload is going to cause the entire trade to turn negative. So if I load it up again, and if I reload and a loss on the reload will turn the whole trade negative, I won't take the reload. And that's more, that a lot of times is really just a product of protecting my psychology more than anything. Some months one might make 3%, other months you might make 23%. It just depends on how fertile the market is.